Hello, thank you for joining us today. My name is Sabrina. I'm with Miter Media, publisher of municipalbonds.com. Today's webinar, Waiting for a Rate Cut, How Will This Impact Your Portfolio, is presented by the DRL Group. Our presenter today is David Loesch, CEO of the DRL Group. David has presented on our air many times before, but in case you've never attended one of our webinars, let me do a little bit of housekeeping. This is a live webinar, and we encourage you to participate. So if you'd like to ask a question during the webinar, please click on the Q&A icon in the Zoom bar below, and we will queue your question up for David to answer, time permitting, during the Q&A segment at the end of the webinar. If we run out of time to answer your question, someone from David's team will reach out after the webinar is over. We also have a polling question open during the webinar, which David will speak to later on. Please participate by clicking on the polls icon below. And now, let's begin. Here is the DRL Group CEO, David Loesch.
Thank you, Sabrina, and thanks for spending your time with us this afternoon on a Tuesday. It's hot in Texas. Hopefully it's cooler wherever you are. I think we're hitting triple digits for the last few days. So very hot, very humid, but it's nice to have a job that you're indoors for sure. I'm David. I'm a co-owner of DRL Group. We started this company. I've been in this business for a little over 31 years, only doing high-grade munis is all that we're doing. It has been a really incredible journey from the standpoint of learning what the high-grade muni markets are doing. That slide right there is for all the attorneys. So this is recorded, so you can go back and look at that, and we'll post this up on our website in a few days as well, so you can kind of go back and review anything that you would like to. The title of the webinar, Waiting for a Rate Cut, it's really interesting because it seems like everybody has been waiting for a rate cut for a long time. I mean, obviously going through COVID and inflationary periods and everything that we've seen over the last 3 years has been quite nerve-wracking, actually, no matter what type of securities you own, whether it be equities or munis or corporates or any type of private equity. It's been a really stressful time, and I'll be the first to admit it's been stressful on a lot of investors, including a lot of broker-dealers as well. We started 2024, and right now the 10-year currently, and I'm looking to my left because I've got my Bloomberg open, is sitting at about a 380. We've gone as high as a 450-ish. Down to around a 360. We rallied over the last few days, particularly today, actually, and sitting at a 380 right now. We'll kind of get into where we feel the 10-year is going to go and really how that's going to impact munis from the standpoint of what's going on and overall thought processes as far as how that's going to relate to a rate cut. You know, the real interesting thing is that we've seen economic numbers really get fueled by different types of job cuts, for example, non-hires, overall mortgage rates and whatnot. And that's really what the Fed is looking for. And they're looking for these overall looked at numbers to where they can make a decision on what they're going to do. What do we think? I mean, really, at the end of the day, what we believe is there's going to be some opportunity for you for the last half of the year for 2024. Obviously, the bet is 100% rate cut in September. I'm not sure if we're going to be on that bandwagon at the moment, but we do see quite a bit of opportunity as we move into 2025 and obviously the last half of this year. August numbers really created a lot of volatility. As I said, the Fed is really looking at a thought process of the data has to prove the rate cut. And Powell has been extremely vocal on that for sure. In July, August meetings, they have really moved their thought processes and their language from more of a hawkish to more of a dovish type outlook. And the credit side has really done well. And what that really means is that's a fancy word of saying overall quality of munis, specifically the A-rated and above, the stuff that we trade, has really held up well. Very low defaults, overall thought is that that's going to continue through 2025, despite or regardless of the fact that we have any type of a recession or anything like that, which we'll get into as well. What we're avoiding higher education right now, specifically the smaller institutions or specifically the ones that are not insured. We're kind of thinking that that's still going to be impactful due to the fact of the whole COVID situation, the pandemic. It really put people back at home and into an online type atmosphere, similar to this Zoom that we're doing now. I used to speak in front of people, and now pretty much everything I do is through Zoom, which is pretty interesting how the world has shifted. Larger institutions, the University of Texas, for example, where we are, wherever you are, the larger institutions, they're going to do fine. Another item that we're avoiding is hospitals. We're not really moving into the hospital sector, particularly the ones that are not insured as well. They're still finding and still reeling from the overall results of the pandemic. So that is really an area that we're trying to avoid. That was when the 2-year fell. I'll put my cursor right over here. End of July, all into August, we've seen a dovish remark from Fed, and we've seen a lot of waging saying that, hey, we will see a rate cut, and yields on the 2-year currently are at about a 3.99 at this very moment. So people are really looking to see this 2-year continue to trade down over time. We personally don't really track the 2-year that much. We really focus on the 10-year, only because of the fact that in our world, that's more of a benchmark. But I wanted to put that up here just to kind of have an idea and put everybody's expectations to see exactly where the 2-year. And like I said, the 10-year is trading at about a 381 to a 380 right now. This is from Bloomberg Intelligence. This is the keys for 2024 and 2025. If you're a bond buyer, really quite honestly, any type of equity buyer as well, from liquidity concerns to changing market structure, the liquidity concern, the reality to our world, when I got into this business 30 plus years ago, there were dealers, bond dealers out there that were all over the place. There were tons of us out there that really traded odd lot paper, serviced the overall individual accounts like you, and also made markets and securities. That has significantly changed over the last, particularly over the last 10 years for sure, because of the fact that everything has gone towards electronic communication, electronic execution, overall thoughts from the standpoint of saying, if you don't have the right technology, if you don't have the right systems in place, you're not going to survive. A lot of those dealers went out of business. Obviously, DRL and others, we went to more of a, let's say, a technology-based firm. Fintech, of course, is a buzzword in our business, probably for the last 3 or 4 years for sure. But the reality is that you had to move in that direction. So liquidity concerns, if you're buying high yield stuff, which we'll get into in a little bit, you might have some liquidity concerns. If you're buying 100 bond denomination issues, you're going to have some liquidity concerns. So with all of that said, we are really going towards a liquidity issue. And there's our results. We'll get to that in 1 second. Let me move that off of the screen there. So with that said, what we're seeing is that we're seeing this really become an issue, this slowing economy. What does this really mean? This means that people are very concerned about a recession. They're very concerned about overall thought processes as far as what's the Fed's going to do and how that's going to impact their bonds, how that's going to impact their securities, their overall investments. We believe, and it's really common knowledge out there, that we think there's going to be some sort of a slowdown in 25, not in the camp about some sort of recession, but definitely some sort of a slowdown. What you need to remember as a bondholder, and make sure that you are talking to the right folks and getting good information. If you're buying tax-backed bonds, particularly in high tax states such as New York or California, you be real mindful about what are the tax collections, have those tax collections increased, decreased? Are they continuing? Are they servicing the debt okay? Have they tapped the reserves, et cetera? So be real careful about that. We think there's going to be some sort of a slowdown tax collection from that standpoint. With that said, it is going to be interesting to see. Going back to the changing market, I think that we will see a changing market because of the fact that people are buying securities. Individual, what's called an SMA, a separately managed account, they are buying securities and they're buying individual bonds. So they're buying the individual bonds to the point where we want to be active in what I own. I want to know what I own. I don't want to buy a mutual fund. I want to be sure I know what I own and how I own it, what price I own it, et cetera, what the insurance is and whatnot. So with that said, we're talking about the two things that matter in the second half, and that's kind of where we go from this standpoint. The reality is that the overall health really depends of the economy, really depends on what's going to happen with jobs. And I hate to say it, but the fact of the matter is that Powell and team are really looking at CPI numbers, which we report on weekly or at least monthly, and they're looking at this overall jobs, whether it's weakness or whatnot. And my thought process is that if the jobs numbers continue to come down slowly, CPI numbers obviously are coming down slowly, then Powell has always said this 2% is going to be their magic number, right? Whatever that magic number is, and they've said 2%. We've always been very transparent about that's an unrealistic number. We just do not see that happening. Powell has already said that he's going to cut before the 2% mark, so that he's already realized that. But fund flows are always a concern as well. So pivoting from economic numbers to fund flows, what that means is that how much money is going into mutual funds, what really is going into mutual funds, and how are things really handling themselves from that standpoint. So mutual funds are very, very, very important to look at. And the fact of the matter is that it's really hard to determine how and what the elections are going to do, particularly with the whole Biden-Harris shift. When I was preparing this webinar, it just had happened when Biden was talking about stepping down. So it really did not have a big impact on our markets, quite frankly, but it is something to consider as far as what's going to end up happening from that standpoint and how that's overall going to, be, what's going to happen with taxes and whatnot. We kind of think munis could be poised for a rally going into the last half of the year. We're not suggesting you buy munis based upon the fact that, okay, I'm going to buy it at 104 and sell it at 106, or buy it at 97 and sell it at par. But what we're saying is that we believe that there's going to be a stronger demand, definitely, for high-grade securities, particularly if we see some sort of a recessionary type period that's going to come in either at the end of this year or our first part of next year. Larger inflows should be expected, meaning going back to those mutual funds right here, larger flows should be expected because of the fact that we're looking at some sort of an idea of people moving money out of equities, going into high-grade securities, mutual funds, that kind of stuff. So I would think that would cause let's say a rally for individual bonds, because let's face it, if you're buying a mutual fund, the mutual fund has to put money somewhere, and they're buying individual bonds. So it would kind of be a domino effect from that standpoint. Larger issuance, 2 minutes, 1 minute on that. At the end of the day, that has been the norm. I think the average volume, what's called visible supply, is around 10.5 billion per week is what we've been hovering at for 2024. I read this morning, I think we're at 15.8 billion or something along that line. So a lot of municipalities are pushing paper out because of the fact that they're thinking, I think that rates are going to come down, and we're going to go ahead and move rates down effectively. So I think that supply is going to continue to be strong for the rest of the year. you would think that's going to have a negative impact on yields, meaning yield should go up. But actually, it's been relatively quite the opposite, particularly for this year, where with the supply being so high, you would have thought that it would be, oh, well, yield's going to, actually, that's not happened at all. It's actually quite the opposite. Everybody's asked us, a lot of our clients have said, hey, what have munis done during a presidential election? What is the overall thought there, and how have they performed? Well, historical returns going back to 1980, and I've got it there, over only two of the 11 election years had losses. So most, and we're not saying buy munis due to the fact that, hey, we're in this election year, we're going to be voting here in a couple of months. It's not what I'm saying, but what I am saying, the facts are the facts. The facts are is that munis have done pretty well in election years, and so they continue to do well throughout the remaining of the balance of the year and into the following year. One would think this would continue. I would think that it would continue, and I would think that overall that we're gonna see some sort of a positive response from that for sure. Regardless of the economy, a lot of our clients say, what is the correlation between munis and the economy? Regardless of the economy, the U.S. appears to be slowing. We've already made that determination. It appears that CPI numbers are coming down. Jobless numbers or jobless claims are going up. Jobs numbers are coming down. Overall thought process there is that spending is slowing, credit card debt is higher. Obviously, new home builds are slowing because interest rates have been so incredibly high for the people trying to buy homes. Everything seems to be slowing down from that standpoint. The sad part about it is that's what the Fed wants. They want that to happen because they want this economy to kind of not stall, but they want it to slow down. So they have a reason, or they have a good solid data point to be able to say, okay, cool, we're going to go ahead and reduce rates. So that's kind of what we're thinking. What's certain is that munis have always been a haven asset class. Whether I realize that through 2020 through 2023, I get it. We own munis, we sold munis, we bought munis, and yes, statements look pretty poor because of the fact that the valuations really were lackluster during those years. And I get it. It was a very difficult time, and that's how I started the presentation. But the fact of the matter is that your munis are going to mature. You're going to get 100 cents on the dollar if you got quality munis, and you're going to collect a coupon along the way, whether you use it to live off of or use it to buy more bonds or a combination of both. The fact of the matter is that you're going to be okay if you own high quality munis. So make sure you're talking to somebody that's really understanding that, because it's very important to have a good, clear understanding of the correlation between high yield munis, as I put in our overall webinar invite, high grade munis, AA insured stuff, and then what is in between. But I will say this, and from a DRL point of view, they will continue to offer you liquidity, safety, obviously tax exempt income. There are taxable munis as well that you can purchase, which we're pretty active in. So what matters for the last half of the year, right? What matters? What matters is that the ratings of munis continue to be strong, but they're slowing. What does that really mean? That really means that as we move into a recession, if we have a recession, and let's just say on this webinar we don't, but let's say we have a slowdown, right? We can define that as whatever we want to define it at. But if we have a slowdown, then you really need to pay attention to the credit quality of the municipality. If you're buying quality insured paper, then again, you should be okay. Nothing is for certain, and we all know that, but you should be all right. If you're buying uninsured paper, as I mentioned before, either higher education, healthcare, small municipalities, municipal utility districts, whatever it might be real careful about that, because the rating agencies have already shot fire over the bow, so to speak, or however you want to say it, saying, hey, listen, we might have some issues. So know what you own. The bottom line is that just make sure you know what you own and you understand what you own, and make sure you talk to your people as far as what's going on out there. We have found, and again, I've been doing this for over 3 decades, water and sewer debt, and again, I'm not saying only buy that either, but water and sewer debt have been havens in a slowdown of an economy, meaning that people still need water and sewer. Let's face it, at the end of the day, that it's just pretty simple, straightforward stuff. So as we're looking at some sort of a slowdown, should there be one, then water and sewer debt is probably going to be your best bet. Again, not saying you load up on it, but it's saying that you would probably be okay with good overall municipalities that are established, first of all, and then have a good track record, particularly the insured ones. This subsector, from the standpoint, it's been a relatively small subsector of the of our world, at least as of late, because if you really think about it, over the last 3 years, what's happened with housing? What's happened with interest rates? What's happened with new purchases of homes? You know, I don't know of any personal developments that have gone under, but I'm sure there's been a few. So as this subsector has been relatively small, but yet people want the subsector, water sewer, pricing will continue to hold because people will continue to move into that sector. So as this asset class is, let's say, bought, then that asset class should do relatively pretty good. Spreads have compressed definitely in that sector, as I put on that last bullet points, and I think it really should have a pretty good opportunity for buyers. Let's go back to the poll, and I'll kind of pause right there for 1 second. I'm just curious from the standpoint of, well, what did everybody think? So how many times do you think the Fed will cut rates this year? 1, 46%, 2, 44, 3, 2%. I'm kind of thinking 1 or 2. I would agree with that. That's pretty interesting. Do you think the Fed will start to cut in September? 76% answered. Short answer, I presume that's yes. So 76% said yes. And then how many basis points do you think the Fed will cut in 2025? I don't really have a good answer here. My personal opinion in 2024 is probably going to be 50 bips. And in 2025, maybe 75 to 100 bips. That's my personal opinion. When time will tell, obviously. And do you think we see a soft landing? No, 24%. Yes, 76%. So that's kind of the poll there. So that's pretty interesting how that is a thought process. Somebody asked, is a recording presentation? Yes, we're recording this as well. Let's go back to structure and liquidity factors in second half of 2024. Liquidity definitely has been strong. Liquidity has been strong because of the fact that, as I mentioned, municipalities have been issuing debt. They have been issuing large pieces, particularly in New York and California and Florida and here in Texas. So we've seen a lot of liquidity that's come into the marketplace over the last, say, 6 months for sure. We have persistent challenges that continue, and that really is sensitive tax issues. Again, not to single out New York, New Jersey, and California, but the fact of the matter is that people are getting very tired of paying taxes to their state, particularly New York and California. Here in Texas, we've seen, as I'm sure everybody's read in the Wall Street Journal and then their local news, people are moving to Texas because of the fact that it's a very business-friendly state. There is obviously no income tax here, just like in Florida. And so people are starting to move their businesses elsewhere. Be mindful of that when you're purchasing securities, and be aware of those high tax states like New York and California. We are buyers of those. I'm not suggesting we're not buying those states, but what I am suggesting is just be aware of what you're buying and make sure that you have a good quality underlying. And if you need assistance, definitely let us know. Should you be buying infrastructure paper? What really does that mean, infrastructure? Well, roads and bridges and airports and maybe stadiums, possibly, but there is a big gap of infrastructure, particularly roads. Civil engineers, you can look it up. There's a big gap from an infrastructure standpoint, and we are seeing a lot of that paper come out. Here in Texas, great example with the snowpocalypse a few years back. Power grids were failing. There was a lot of problems. I know we made a lot of bad press out of that, but that's an infrastructure issue. Texas issued a big, large bond issue at the beginning of the year. I just read just a little bit ago this morning that there's a lot of power that is being generated and needed because of AI or computing power. Obviously, you've got battery power coming on board with the whole, funding of cars and whatnot. So infrastructure will be something to watch in 2025 for sure. Roads and bridges and airports and all this other kind of stuff. That, going back to the airports, you guys remember in 2020 when we had COVID, no one was traveling. You had your RCLs of the world, your airports of the world, Delta, United, all of these guys were having major problems. You couldn't even sell an airport bond because no one really knew what was going on. Obviously, now we're seeing a large uptick in travel, and we're seeing a lot of issuance coming through from the standpoint of saying, okay, look, we're going to issue a transportation bond, whether it be for Atlanta Hartsfield or Houston Bush or wherever you live, New York LaGuardia, which just went through a renovation. So all of that's going to continue for sure. And in our opinion, it's probably not a bad idea. It's probably not a bad trade to do from the standpoint of saying, hey, look, I think it's probably a good purchase as long as you've got a good transportation sector. Look at that graph right there. That's where the opportunity should be in 2024 and 2025, tolls and highways. I do think that that is going to be a pretty large issuance sector for the next year or two because of the fact that, let's face it, a lot of these bridges, roads, tunnels, whatever you want to talk about, they're deteriorating. So that's going to be a pretty good sector. I would think that most of that stuff's going to be insured, and I would think it's going to be relatively fairly strong from that standpoint. Let's talk about, will the Fed cut? That's as of 7/11. I want to point something out for a second. That's the next Fed meeting, September the 18th. September the 18th. So everybody's thinking, okay, read this a little backwards. 91%, I think it's going to cut. So that was as of 7/11. Look at it now, 164%. That was as of 8/8. So, the reality is people do feel they're going to cut in September. I am now in that camp. We were fairly transparent that I was a little suspect of a cut in September only because of the fact that I was thinking they didn't want to really be viewed as a political aspect or a political move. But now it's almost like, oh man, the jobs numbers are getting weak. The CPI numbers are coming down. Probably need to cut. So, now we're kind of looking at, well, that's probably going to be a likely scenario for sure. Market pricing, more than 2 cuts for 2024. We think so. And forget about us. That's most of the people out there think that we're going to be seeing more than 1 cut, more than 2 cuts maybe for 2024. That's the dot plot. That's what everybody talks about and everybody does. But I put there, anxiety reached a new level in August. The reality is that what has happened is that so many people have been so fixated on this whole cut that, hey, these guys need to cut or they will cut. The fact of the matter is, does it really matter? They're going to cut at one point in time, whether it's now, whether it's in 2 or 3 or 4 months from now. The fact of the matter is that rates are going to come down. Period. Unless we have something we're not seeing. But the fact of the matter is rates are going to come down. Trade into that because of the fact you will be very, very happy over a period of time. What is the Fed saying? So I kind of put together a little, call it a timeline. July, at the end of July, I should say, Jerome Powell said interest rate will come as soon as September. That was July 31st on the day. That's when they voted to leave the benchmark the same. That's also when they said, which they said it before, you know what, guys, we're probably not going to wait until it gets to 2%, CPI 2%. We're probably going to do it before then. So that's pretty common knowledge. Goolsbee, he's Chicago Fed. Hey, we're not going to overreact to one report. He's starting to lean now toward, well, okay, we're seeing this data really come into play. We're really going to think about cutting pretty soon. Richmond Fed FOMC voter indicated U.S. economy is in great shape. I know I'm going from bottom to top, but at the end of the day, it's unclear. Everybody's focused on the labor market. Again, the fact of the matter is I'm not going to get into debate whether they're going to cut tomorrow or what, but the fact of the matter is that rates are probably going to go down. And then San Francisco president said, hey, look, the labor market is softening. It's definitely softening. The data speaks for itself. We're not making this stuff up. You can just go to CNBC or whatever thing you want to go to and look at the data. At the end of the day, the data is definitely softening. Should the Fed wait? We've already talked about that. No, absolutely not. We have been so transparent on that and very vocal on that. They should not wait for 2%. Period. They shouldn't, because of the fact that if they do, it's going to be way too late. So, and they already know that. I mean, listen, they're a lot smarter than hopefully we give them credit for. So, I mean, the fact of the matter is they shouldn't wait for 2%. Second half of the mandate Fed's numbers. Hey, look, you know what? Jobs claims are rising, change in non-farm payrolls, CPI down, by the way, from 8.5%. We're down around 3% now. The bottom line is the numbers are coming down. I don't think they're going to wait. I don't think they ever were going to wait. I think that was just some pie in the sky number that they made, and it's just not us. A lot of people feel that 2% is totally unrealistic, and it shouldn't even be coming into the play. So what's it going to take? What's it really going to take for the Fed to lower rates? The Fed is going to lower rates based upon the fact of say, well, the economy's slowing, we're going to lower rates. It's as simple as that. And the fact is that that's probably going to happen in September. Buying bonds now into the September meeting probably will do you good. If we're wrong, and let's say they don't cut for some reason, which is a possibility, then there's probably going to be language on that Fed FOMC docket after Powell speaks that's going to say something to the effect of, well, we didn't cut, but we're probably going to cut after the elections. We're probably going to cut in November. You know, the fact of the matter is, whether they cut or not, rates will most likely move down no matter what. Because if they don't cut, there's going to be language. If they do cut, self-explanatory. We're data dependent. We've already talked about that. I wanted to put that up there. That's the unemployment numbers. So obviously, of course, this is COVID. You know, we've all lived that. And then you can see how they're starting to rise. It's not going to take a lot for the Fed to go, oh, man, oh, golly, we need to really be sure we understand what's going on with the unemployment numbers. So they are rising. And then the weakness behind the top U.S. job figures. The fact of the matter is also the job market slowdown. Powell wants it to be gradual. And it is gradual. We're not convinced per Powell to see a rate cut and us when I wrote this in September. However, odds are growing. Well, we've already looked at the odds. It's a massive odds, pretty much 100%. We'll wait for September and see what happens. But at the end of the day, it doesn't matter. I'm not going to repeat it. It's not going to matter if they cut or not. Let's go to your account. Let's go to, is your account positioned for a rate cut? Let's figure that out. If you have a bulk of your account in less than 4-year paper, I think you're going to struggle, because what's going to end up happening is that if they cut, if they don't cut, well, not here to debate it, rates are going to go down. Most likely rates will be lower in 12 months from now. All right. So if rates are going to be lower in 12 months from now, and you own 1 to 2 year to 3-year paper, you're going to look around when those bonds mature and go, okay, what am I going to buy? Most bond buyers, and I'm sure you understand, most bond buyers will not take the principal. They just reinvest it and live off the interest. What are you going to buy? What are you going to buy, and how are you going to buy it? So it's just not going to be a very good situation if you own shorter term paper, in our opinion, and others too. Longer term 4% bet coupon paper is going to hold well in a rate move. So we try to stay around 4 or higher % coupon. We are buying 3 to 3.5% stuff pretty cheap. And that's going to run fairly hard once the rate cut happens because of the fact that that stuff trades 10 to 15 bips cheaper only because of the coupon currently. So be mindful of the credit quality as well that you own. Very important to make sure that you understand. So if you're buying 4% paper, 10-year paper, 15-year paper, try to keep call dates mindful as well. You're going to be just fine. So just be aware of that. I got a lot of questions on high yield munis. Why don't you sell high yield munis? Why don't you guys do that? Why don't you sell something that's yielding greater than 4.25 or 4.5%? Here's the reason why. It's because we don't want the hassle. I hate to say it, but the fact of the matter is that if you're buying high yield paper and you buy something in 2024, 2027 rolls around and you get a letter in the mail saying they tapped the reserves and all of a sudden your bid's down 15 points, that's a problem. We really don't trade that security. I'm not saying it might be good for you and you might want that risk, but looking at the credit risk, looking at the volatility, looking at the liquidity, the fact of the matter is it's higher risk. We don't trade that. If you feel that you need that paper in your account to juice your returns, then go after it. That's great. That's your prerogative. But from our standpoint, we're not buying it. If we see some sort of slowdown, which we might not, don't know. I'm not here to say we are or not. That paper is going to struggle as well. So if you're buying that paper, be real careful about that. Where's the yield curve? Where are we buying? We're buying 10 to, as I mentioned, 10 to 15-year paper. We're trying to stay 2046, 2042, 2037, in that area from that standpoint. Don't really see a lot of value buying 1 to 2 year paper, other than the fact is unless you've got a lot of cash sitting around, you don't want to put it in money market accounts, or you've got your money market accounts tied up and you want liquidity in a year or a year and a half or 2 years. And you want to earn that overall thought from the, okay, well, I'm willing. You can buy cheap paper, by the way. You can buy it 1 or 2 year paper. It was trading at about a 4. It's below a 4 now, but it's fairly attractive. Just be aware that when that paper matures, you might look around and go, well, I'm not sure really I want to invest money into that. So we're buying 10 to 15-year paper from that standpoint. Rainy days, states are jam-packed. I mean, they have a lot of money from a rainy day fund standpoint. That should make you as a bond buyer feel really, really good because of the fact that they've got monies in case of, they call it rainy days. I don't know if you call it a COVID situation or a 9/11 situation or a combination of both. But the fact of the matter is that they have been increasing. They're down a little bit, obviously, but they're still high compared to where they were, say, 3 or 4 years ago. That's something that people really don't talk about, and it's worth talking about. And then are you getting what you need? Are you getting available timely information from your folks or from whatever data provider you use, whether it's Emma or anything else for that matter? Make sure that you get what you need. You know why? Is because of the fact that the individuals out there, those blue lines, the individuals out there, you own the bulk of the munis. Make sure that you understand what you own, who you're dealing with, how long they've been in business, have they traded through situations like Meredith Whitney. I mean, a lot of folks don't even know who that is. I'm sure a lot of you do. 08, 09, 2010, obviously 9/11, Orange County crisis, when they filed bankruptcy back in 94, Washington whoops, going all the way up until, of course, COVID. So, make sure you understand who you're dealing with and what they've traded through, because it's really important that you understand what you own and who you're dealing with. The bottom line, we're about done, and I appreciate your time, and I really appreciate you listening. It's I'm very grateful to be able to talk to you guys. We believe rates are going to go lower. Not just us. That's pretty self-explanatory. I think we've made the case on that, and I think CNBC just beats that to death. Data is going to need to show signs of weakening. I believe that's going to continue along with others. So that's probably September rate cuts. When I wrote this, which was about 2 weeks ago, we gave it a 50% chance. I'd probably say greater than 70% now. Stick with quality in case we have a recession. Going back to that, should I buy high yield? Should I buy bonds that are yielding me 5%? Go right ahead. That's fine. That's your prerogative. But just be mindful of the fact that if we have a recession, those are going to get hit for sure. If you're buying 3% coupons insured, you're going to do fine. 4%, you're going to do fine. 15 to 20-year paper, 4% minimum is what we like. Again, to touch on that 3% stuff, if you're looking for capital appreciation, you should be putting a piece of that in your portfolio as well. And I know I don't have that on there, but that's something that you should consider. And be sure you're working with a trusted advisor. I'm not suggesting that you're not, and we're not looking to take your business away from your advisor. All we're looking to do is provide you data and to provide you offerings from the standpoint of munis. That's all we do. How can we help? 30 plus years. I've already said that multiple times. We've traded through every market type that you can think of. This last inflationary period has been very, very difficult. And I realize it's been difficult for everybody, but we've traded through it. And I think we're kind of at the tail end of that. I've already mentioned timely markets. We provide commentary twice a week, commentary specifically on markets. We're not trying to sell you a subscription or anything like that. The fact of the matter is we're providing you commentary, and we're going to provide you honest and precise communications based upon your objective, not based upon ours, based upon yours. Our custodian, who I have not mentioned, is National Financial, which is Fidelity. So our custodian is 100% owned by Fidelity, and we're going to help you guide through all of this as we've seen and as we've talked about. So with that, I'm just saying that we really value you, and we value our thought process in making a relationship with you and how we can make that relationship with you. So I appreciate your time. I really appreciate your signing up for the webinar and listening all the way through. I hope I didn't repeat myself too much, but the fact of the matter is that I think we've all concluded high yield debt, be real careful. Rates probably are going to go down. Make sure you're working with a trusted advisor, and make sure that that trusted advisor knows what they're doing and have traded through multiple of these types of things. So with that said, we are pretty well done with the webinar, and I am really thankful that you joined us, and I really am thankful for this fact that you spent the afternoon with me on this, and I hope you took something out from it. So thank you very much for joining. Have a wonderful rest of your day.